Hey, good evening, everybody. Uneducated economist. I hope everybody had a great new year. Thought I'd come out today and talk a little bit about different terms that you might hear in financial talk that you might not be aware of their meanings, or you might know what the definitions are, but you're not quite aware of how they're using it inside of their speak. So I thought I'd come out today and talk a little bit about the different terms. So the first one, fiat currency. This is a good one. So basically, the currency that we use today in the United States and pretty much across the world is fiat currency. And fiat currency is basically money by decree. It's just like as if a government or a king saying, "Here's the money that you're going to use," right? And it's not like by the people's choice; it's by the government's choice. This is what you'll use. And for the most part, everybody kind of thinks about fiat currency as being fake currency, but it's not really fake because it is there is like it doesn't necessarily have to be like paper dollars that are in existence. Like the one of the more common fiat currencies that existed for hundreds of years back in history was tally sticks, and what tally sticks were these sticks that had marks on them that were split in half, and half of them would go into the king's vault and the other half would go into commerce, and then when taxes were due they would line up these tally sticks, and that was how taxes were paid. And that was currency for a very long time. Tally sticks, that was kind of an interesting story. You should look that one up. So fiat currency, money by decree, it's money that's the government say this is your currency. And if you have like kind of still don't quite a good grasp on it, look at my video Market Break, and for the first few minutes in that, it kind of talks about the difference between silver certificates and Federal Reserve notes, and you might get a little bit better idea on the difference between fiat currency and hard currencies, so to speak. Dead cat bounce. I love this one. My wife looks at me funny every time I say this one. Dead cat bounce. What that refers to is when an asset or a stock or something runs way up and then it falls off a cliff, like the price dramatically drops and then it bounces, right? And you have a pretty significant bounce where it looks like it's as if it was going to, reach its all-time highs and go higher, but it doesn't. It doesn't quite make it, and it starts falling back down the other side. That that is referred to as a dead cat bounce when it can't quite make it to the top again and it starts to fall. Equities. This is a good one. A lot of people don't know what equities is, and when you hear or what equities are, in you'll hear like people say the equities markets or equities had a run, or they'll talk about equities and they're not quite sure what that means. It's stocks. That's it. Just stocks. Equities and stocks are the same thing. Haircut. This one was interesting. The way I originally learned this one a long time ago was like I always thought it was like when an investor takes a loss on their asset that they sell, they get a haircut, but that's not what it is. What a haircut in the financial speak, at least in the true financial speak, is if as an investor you want to borrow money to make an investment and you use a collateral asset to do it, right? So you have collateral, and generally you have like a bond or something that you want to use as collateral to borrow the money to buy a different investment. The amount of money that you can borrow against that asset, so say you have $1,000 bond that you want to use as collateral to buy something, right? So you got $1,000 bond, but you're not going to be able to get $1,000 loan on that, right? So they may only loan you like say 10% less than the actual value of it. That 10% is the haircut that you will take. Okay, so instead of getting $1,000, you only get 900. Okay, so that 10%, and so like maybe during say rougher times or financial concerns, it may go from 10% to 20. So investors have to take a 20% haircut, okay, in order to borrow the money for that asset that they have, okay. But yeah, a lot of people get that one confused. They think it's kind of like a loss that investor has taken on their investment, but that's not exactly right. Here's one: sovereigns, securities, bonds, treasuries, notes. Those are all the same thing, guys. They're all instruments of debts. They're all like basically loans or borrowing from the government or say corporations to, it's they're basically loans, okay? And if you kind of understand what a bond is, all of it's the same thing. Sovereigns is sovereign debts. Securities are generally referred to the whole thing, whether it's corporate debts or government debts. Bonds are usually longer term or referred to like a longer term debt, so like years out are referred to bonds. Treasuries are usually coming out of the government, like the U.S. Treasury. They'll refer to like the ones that are coming out of that particular institution itself as treasuries. But these are all the same things. And then like notes are short term, loans that the government issues out. So bonds would be longer, notes would be shorter term. Those are all the same thing. So yeah, when you hear when you hear people saying if they say those sovereign security bonds, treasury notes, they're referring basically to the same thing, or the same type of thing. Bail-ins, right? A lot of people don't understand how a bail-in works. Like they kind of got how the bailouts work because we experienced that during the financial crisis. Like a bailout is where a bank is failing, they're on the brink of failing, and like taxpayers, usually governments, but taxpayers will come in and bail out the bank. Bail-ins is where all the depositors and creditors of that bank take a loss. And usually what ends up happening, like Cyprus was a good, like, I don't know if you guys remember back in the day, Cyprus, like quite a few years ago, they had a round of bail-ins. And basically what happens is they froze everybody's assets at the banks. Like you went down to the bank and nobody would open the door. You couldn't pull any money out of the ATM, right? And they limited the people to like, you could only pull out so much amount in a particular day. And they froze like all the assets or all the deposits that everybody had. And if you had a certain amount above, like if you had like, I don't know, I can't remember what the number was, but I'm just going to pull something out. Like if you had $200,000 or more, then they took a certain amount of that or a chunk of it or however it worked, and they would bail out the bank with that, right? They would get that to, try to bail out all their basically their creditors, everybody who loaned them money. So anyway, bail-ins, that's how that one is. And bailouts was, the government's doing it. So bail-ins is when the people who are in the institution take care of business. Bailouts is when people from outside the institution come in to take care of business. Quantitative easing and quantitative tightening. So quantitative easing, this is where the Federal Reserve printed up money and bought treasuries, bought the United States bonds, right? And they put those on their asset sheets. They also bought a lot of other things like mortgage-backed securities and stuff like that. But basically, the big quantitative easing was when they printed up money and started buying U.S. debt. Okay, now they took all that and they put it onto their asset sheet. So they ended up like swelling their asset sheets into like trillions of dollars. And so that was quantitative easing, where they were printing up this money and buying those government debts, right? Quantitative tightening is the reverse of that. That's where they're selling these bonds onto the market, okay? And they're doing it right now at like I think 50 billion, and they're supposed to increase this. So they're supposed to be selling more and more of these things onto the market. And when you start flooding the market with more and more bonds, what ends up happening is it causes interest rates to continue to rise. So this is kind of like when people say that, I don't see the Fed raising interest rates in the future. Well, then that means that they would have to stop the selling of assets, right? And then if they actually turned around and started buying assets again, well, that would be quantitative easing, okay? So right now that we're in quantitative tightening as they try to sell these assets, but, things could reverse where they'll start printing up the money again and buying these assets again. And then the final one, price to earnings ratio. A lot of people ask me what price to earnings ratio means because they hear it a lot on the financial, and it's real easy. Price to earnings is really simple. And I'm not going to go into like how all the analytics work on price to earnings, but what it exactly is. So earnings, the earnings is real easy, right? So, if a company earns $1 million and they have 1 million shares outstanding, then their earnings is $1 per share. Okay, if they earn $2 million and they have a million shares out there, then their earnings is $2 per share. Okay, so the price per share is how much somebody's willing to pay for it, right? So same thing, if they have 1 million shares out there and the price is selling for $10 a share and their earnings is $2 million, then their price to earnings is 10 to 2, right? Or a 5 to 1, 5 PE ratio. Right, so that's how PE ratios are, or the price to earnings. Real simple. It's just basically it's a good way of calculating like pretty much market sentiment on the value of a company. So like if you have a very low PE ratio, it's like people who are not really they feel a lot of risk towards this company. That's why they're not buying it. And if it's way off the charts, then it's just like way overvalued. Like if you have a PE ratio of 100 or something like that, then basically, you have like a company that's just like, like investors just have dumped like tons of money into, causing the, price of the stock to go way off beyond its earnings, compared to how much it makes. So anyway, I hope that helps out a little bit. There's probably stock analytics out there or people who can talk about, PE ratios who will just like smoke me on as far as that goes. But that would give you kind of an idea on what PE ratios are. All right. Uneducated economist, talk to you guys later.